David Bahnsen is founder and CIO of Bahnsen Group, joins us with his perspective on things and markets, basically, in general. David, lovely to have you on the show. Thank you very much for your time, evening your side. What's your own read on what to expect from the Fed next?
Well, I think there's almost no doubt that they'll be cutting another quarter point as the futures market is priced in for a little while now. And then I think they'll give some guidance as to what the expectation will be next year. Their language is almost certainly going to be flexible, talk about data dependent, talk about, needing to pivot around their read next year. But I think that they've more or less decided that they're going to take another half to full point out of the yield curve by this time next year. And most of that is not related to them believing that there's a big economic slowdown. It has to do with the maturity wall of debt. There is such a massive amount of both corporate debt and commercial real estate, not to mention, of course, governmental borrowings, that I think the Fed is looking to give relief to those overly levered borrowers.
Right. And so give us your own take, David. What does this really mean for the market move from here? Because we've seen enough and more upside for the S&P 500. I mean, we're talking about pretty much record highs for the benchmark indices. Now, if in anticipation, the move has already happened in terms of what Trump could mean for corporate profitability in the U.S., then what happens in 2025? Do we see more headroom for the markets, or does it start to get into a period of consolidation?
Well, I think that whatever happens is not going to be related to the Federal Reserve. I think that the Fed as a primary mover of markets is very overrated right now, and that the issues you ask about for 2025 are largely going to be related to valuation. The market is expecting 15% earnings growth in the S&P, and it may very well get it. But even 14 to 15% earnings growth is already being priced at 22, 23 times. So for next year. And so you are in a competition in the market right now between valuation and fundamentals. Fundamentals are fine. Earnings growth is good. Margins are good. Revenue growth is fine. Valuations are quite stretched. And so will 2025 be the year in which you get a reversion to the mean in valuation? I think that's the big question that index investors have to face. To us, as dividend growth investors and with a more value orientation, I think it's a very good time to be selective and not dependent on a market cap weighted index.
I also want to get your sense in, David, on how you're going to be playing the tech theme with the large caps versus the small caps, because obviously there's a lot of focus on the Russell 2000 names and how there would be broader market participation in this up move once Trump takes office.
Well, markets are forward-looking mechanisms, and so you saw in the month of November the Russell 2000 move up over 11% in 1 month. From trough to peak, you're looking at a 50% return already. So my belief is that there's still some great pockets of opportunity in smaller and medium capitalization companies, but I would not be using an index to play the small and mid-cap theme. It has to be more selective. And very candidly, there's still too much low quality in the small cap index. There's still roughly 50% of the companies that have no earnings whatsoever. And so to find those areas that have more attractive valuations and a better earnings profile is what really you want your small and mid cap manager doing.
Give us some specifics, David. I mean, what sort of themes are you looking to play? Where would you be selective?
Well, again, we're dividend growth investors, so we're not ever looking to play a theme. We're looking to be long-term invested in any company, small, mid, or large, that we see a dividend that is growing and growing sustainably. We want to enter a position at an above-market dividend yield and then see the company's free cash flow grow in such a way that we believe that is sustainable, and that high single-digit growth of the dividend indicates a healthy company, and that's our orientation. So we tend to run a much more concentrated portfolio, only about 30 companies at any one time. And what's really amazing is that this avoids Mag 7, and you would think it would have led to really inferior returns. But here we are year to date, up 28, 29% without owning Mag 7, without taking that concentration risk. Really good asset managers in the financials, really good energy performance in midstream, and yet you still have laggards with healthcare and consumer staples. We think that defensive area of the market might prove to be a great place in 2025.
Got it. Okay, David, stick around because we're going to continue this conversation. David Bahnsen of the Bahnsen Group does stay with us.
We are back with David Bahnsen, who is founder and CIO of the Bahnsen Group. David, what are your thoughts on the whole deregulation narrative that's doing the rounds under Trump, and what would that mean really for, spurring market activity even more and, dare I say, fueling speculation in the markets as well, something that we've seen with Bitcoin already?
Well, deregulation has to be applied to each sector in which it takes place. Financials have been the top performer and since President Trump was elected. Energy is an area in which deregulation will help a great deal. I'm far less interested in what deregulation means to the crypto space or Bitcoin, because fundamentally the price of Bitcoin is not related to the level of regulation around trading it. And so that price will either prove to be speculatively too high or not. But we're agnostic about it because we don't consider it to have any internal value. The deregulation is a really big story when you're talking about the real economy. And we saw in the first Trump administration, there were a lot of benefits around certain deregulation, but I don't think it was always very thoughtful and always very organized. It seems to me now there's better personnel and a better strategy for deregulating, and the financial, energy, industrial space all seems to agree.
And so what does that mean for banks especially? Because beyond a certain point, deregulation can actually be harmful to the leveraging cycle. And I believe that some of those products that led to the global financial crisis are back in the market. They're not thriving, but they're back in the market. And so is there a worry?
No, we're not even in the same stratosphere of what took place before the financial crisis. First of all, a lot of the regulations you're talking about with capital requirements are not at the purview of the president. So there are federal requirements, Federal Reserve requirements that they have already made significantly more stringent in terms of Tier 1 capital and something that is more resembled Basel III. And frankly, it's probably overly tight as it is. I certainly agree with you that if there were no regulation at all around any of the products, you have to wonder what is going to slip through that creates systemic risk. But where the biggest benefit so far has not been in the banking system. In private credit, private equity, where depositors are not the ones holding the risk, but individual investors, which to me is where it ought to be. Those who will bear the reward, bear the risk. That does not create systemic risk. And so deregulation in some of those private asset markets, hedge funds, et cetera, is a very interesting environment for investors and risk takers without adding to the systemic risk of which you speak.
David, I do also want to get your sense on how, so banks deregulation is one space. The other one is energy, and drill, baby, drill. How does that lead to energizing the energy stocks that are already doing very well because of total returns being high on the back of higher dividends?
Well, our point is that the great story, I think, in the energy sector is not necessarily upstream. I'm not sure that a lot of the big producers in the U.S. Permian Basin are going to be producing a whole lot more, especially not with oil between $65 and $69. It's the midstream sector. It's getting more pipelines built that they desperately need, the ability to move and take away more oil, not requiring rail and train. It's environmentally safer. And then the export LNG capacity by building more terminals that can export liquefied natural gas. It's a tremendous growth sector. So there's a lot of opportunity in midstream. Now, it's not cheap, meaning it's really had great returns the last several years, but it still is looking at very wide yield spreads, a lot lower leverage than it's traditionally had, and really fundamentally strong cash flows. We like midstream energy a lot. Of course, his Secretary of Energy nominee was himself the CEO of a large fracking company. There's really just a great environment right now for a midstream energy investor.
Good stuff, David. Thank you so much for your time. We've got to leave it there. That was David Bahnsen of the Bahnsen Group. Thanks so much for joining us here on Street Signs.